You would call this a puzzle then?
We call it a puzzle.
If I could start with you, Nadja, you've been doing research into the interest rates that SIN firms can get from banks.
Yes, we just presented this morning a paper where we look at what SIN firms do have to pay to banks. And SIN firms are firms that are in the alcohol, tobacco, and gambling industry. And in equity markets, previous research has shown that these firms have to pay higher rates. So they have a higher cost of equity because equity investors really seem to avoid these firms, seeing the business as somewhat being irresponsible businesses. Yeah, and much to our surprise for debt markets, for bank loans indeed, we find that actually the SIN firms pay a much lower rate to banks. It's a puzzle to us. We've looked at a number of explanations, like classical explanations like cash-rich firms, transparency, banking relationships, but so far we really haven't found a good theoretical or empirical explanation for our results.
You would call this a puzzle then?
We call it a puzzle.
Do you have anything to add to that, Shaun?
Yes, so in my work I'm looking at impact investing, particularly how investors make investment decisions with two goals in mind. Both they want to further some public good, something that society values like clean air or reducing recidivism, but they also want to retain some sort of private good, some financial return. So it's kind of, there's a dual purpose in mind. And so when we look at the equity markets and we see socially responsible investment, what we're looking at is how does that actually further the needle in terms of some social goal? And what our model shows is that direct investment in socially responsible firms, what that does is that reduces firm management's revenue incentives because they're retaining a smaller fraction of the firm's cash flows, and allows them to really think about the social goals relatively more. And so you're actually going to get them to favor social outputs relatively more than, say, revenue production by directly investing via equity in socially responsible firms. And then what we do is we take that intuition and we say, how can we do better? And so what we think about is how we can design financial securities that are both going to lever limited social capital, but also create the proper incentives for firm managers to undertake social projects. So in public works opportunities, an output of our model is that social impact bonds, or pay for success bonds, are a rational and optimal mechanism as far as levering limited social capital and furthering social goals. But in the private sector, incentivizing impact investing, it's going to be a different flavor. And so what the optimal security looks like in that setting is what we would call a pay it back for failure type of security. And we coined it a social impact guarantee because in those states of the world where investors get paid, those are the states where social goals have failed. And so investors are getting their money back when the social goals that they care about are not attained.
Has that been put into practice anywhere yet?
So social impact bonds have been. So they've been undertaken in both the UK, Australia, the United States. They've been picked up worldwide. But there's a vast number of projects in the private sector that have been untapped because we haven't really thought about how do we use financial securities to accomplish these goals. And so we hope that our research furthers the needle in our understanding of using financial innovation to create more social good.
Paul.
Yeah, so I've done research with millionaires, and I looked particularly at their giving behavior, and that's pretty relevant because 80% of the donations in the Netherlands, which is where my study took place, come from the 20% biggest givers. So that means if we understand what motivates these people to give, we can really activate a lot of capital for the social good. And the main finding from my research is that you want to tap into the giving mindset of the millionaires and have to be careful when you put them into a bargaining business situation. So if I link that to what Shaun is telling about impact investments, then here you can actually think about presenting this in two different ways to clients. So you could either stress the financial returns of these impact investment products, or you rather stress the social component. And what my research suggests is that the social component is going to be more effective, but I don't know that based on this study alone. I did an experiment now, and I'm going to investigate in the future whether indeed if we position products, impact investment products based on the social impact, whether that is going to further strengthen those when selling them to clients compared to a financial frame where you really put a lot of emphasis on the returns.
Nadja, do you have anything to add to either of these two statements?
Well, I think this research is just going really into the right direction, because what we already see in equity markets nowadays is that if investors rush into firms, right, and we see a lot of institutional investors really implementing environmental, social, and governance factors, and these factors becoming mainstream, these firms they rush into will not earn higher returns. So there will come a point in time where ESG investing is just, or sustainable finance is just like mainstream investing, and where we would expect firms with higher sustainability standards to potentially have lower returns. And then the question just comes in, are people willing to potentially give up return to still kind of make the world a better place, to do good? And the question is, how would these products be designed? I think that's basically where both of their research comes just in at the very right point, or at the very right question. That even at the point in time where we come into this equilibrium, how is sustainable finance then going to develop? And how will the people then be convinced to buy these products?
It occurs to me that when it comes to design, your work is the most important in this field, Paul. Do you think you have any particular suggestions for what your research means for design of these assets?
So I think when I look at how financial advice is organized, for instance, right now, then clients have a separate advisor for talking about investments, and then they might or might not have an advisor talking about philanthropy. And I think that we are moving much more to a continuum on the two, where you say, I want to do some good, and I can do that in the form of a charity, but I could also do it in the form of an impact investment. So therefore I think like a much more integrated approach, whereby you advise a client, give him a sort of a social budget, I want to do so much good, and then divide what is the best instrument for doing that. Is it charity or is it impact investments?
And I think it just comes in doing good with your investment. It comes in more natural, given how people are. So if you go back to the sin firms, right? It would be counterintuitive to, on the one hand, invest in tobacco stocks. In equity markets, you can earn a relatively higher return with that. And on the other hand, to donate money, I don't know, for lung cancer, for instance, right? So that would be just for people a counterintuitive thing to do. So I think these products, they would just actually be much more natural to people than on the one hand have an investment, on the other hand make a donation to kind of undo the harm of your investment. That's pretty counterintuitive behavior.
Yeah, I think this is a really important discussion, because I think that there's this misconception out there that socially responsible investing is a win-win. You're going to somehow outperform and also further a social goal. And there is some empirical evidence that that's happened in the near term with some types of investments. But that can't be an equilibrium, because basically what we're saying is socially responsible investors are adhering to a set of constraints in the type of things that they're willing to invest in. And you can't think of any logical model where someone committing to a set of constraints is going to outperform someone that is unconstrained. And so I think we're really moving the needle in terms of thinking about how we take people's natural tendency to want to engage in philanthropy and bridging it with investing. Because I think that there's this idea that if we think about the risk-return trade-off, more risk, more return, when we think about social impact, it's actually going to move in the opposite direction. The more social impact that you're going to generate, it's probably going to sacrifice something in the return dimension. And I think socially responsible investors really need to have an understanding of that trade-off if we're really going to get more bang for our buck with our investment dollars.
Right, and I think what I can add to this is, so I did a study with a big asset manager, Robeco, among its clients. And so what you see is that many impact investment managers stress the fact that sustainable investments provide better returns. Well, and actually when I just ask investors, what do they expect? Most of them expect lower returns. So if you constantly try to tell them, you get higher returns, but they don't believe it, they still believe they get lower returns, which actually might also be in the long run the case, then you're really missing the point. Whereas what I saw in that study with Robeco is that actually the investors, the social sponsor investors, are driven by their social motives. So stressing that is, I think, much more effective.
Yeah, we've recently done a survey just in Germany, people on the street, and it pretty much confirms So that people, they like SRI, so they were also in the survey, of course, which is not real money, so it's always, you need to take it with a grain of salt. But the same thing showed, they believed in the lower return and they still wanted to invest socially responsible.